close. I don't need to get on an airplane. I can get in the car, and I'm in Minneapolis. You know, it's very similar to where I live in Winnipeg. It's Canadian. They have cold winters. They have kind of, you know, but they have that kind of friendly Canadian thing. There isn't a real cultural difference the way that you might see a cultural difference, say, if you went to Texas, right, where it's a lot more Spanish influence and that sort of thing. And just people are different in Texas. It's more like Alberta. Another good thing, though, talking about red zones and ghettos, I mean, talking about me who lived in a, you know, who has all those rooming house properties, they're essentially in a ghetto in Winnipeg. Minneapolis has less ghetto area than Winnipeg does. It's got less red zones. It's got less areas where the banks are going to say, no, I don't want to go there. You can't buy this property and get financing if you're there. I'm not aware of anywhere in Minneapolis that the banks in Minneapolis won't lend on. I can draw you on a map of Winnipeg, lots of places where they won't lend on, and not all the property I own that's in those areas. So, yeah, there's a lot of them. But the final one, and this one, you know, I put it last, but really it's the critical one. Kyle was there. Kyle's been investing in real estate much like Al had. He's a trusted partner. His dad started him out when he went to college. Instead of having Kyle live in a dorm room in a frat house or whatever when Kyle went to university, his dad said, no, you're going to learn real estate. We're going to buy you a house. You're going to pay for this house by putting 5 or 6 of your friends in there, and you're going to have to manage the house, and you're going to earn your keep by being the property manager. And that's how you're going to learn real estate. You're going to be the landlord to all your friends. And when you guys go and have a party on Saturday night and you want to break a bunch of windows, just remember it's coming out of your pocket, not mine. So Kyle learned real estate the hard way. We met on these EWI courses, we hit it off, and he wanted to do more stuff. He had reached his wall. He had as much as he could in his IRA, and he had as much as he could in his wife's IRA, and he had as much as he could. And he had a couple of joint venture partners and the one guy, and they had like 20 properties together, and he had as much as he could with him. So he was tapping out in the like mid-20s, and he was like, Keith, we should do something together. And I was like, Kyle, we should do something together. So we brought in my friend John, whose cousin lived in Minneapolis, and so he and I did our schooling together, and we started, you know, putting a structure together. And so we looked at structures, and we're like, well, if we're going to be Canadians investing in the U.S., we want to protect ourselves, because we know that the lawyers down there will work on contingency. And it's all well and good if you're going to own a vacation property in a warm area yourself and let your friends use it or rent it to your friends. But if you're actually going to go out there and rent it as an investment to Americans, you have to be aware of what the American lawyers, you know, will do to you. You know, the slip and fall was, I heard a number that was as much as 94% of all tort law, which is the whole lawsuit, personal injury stuff, takes place in the U.S. U.S. is what, 4% of the world's population? They got 94% of the slip and fall lawsuits. Yeah. So, little preface here, I'm not a lawyer. I've talked to a ton of them. I'm not an accountant. I've talked to a ton of them. I wasn't going to fill my slides with a whole bunch of like, so here's my lawyers and all that kind of stuff. But my cards are at the back, my cards are at the front. If anybody wants to know like who I've used for attorneys, who I've used for accountants, who I've spoken to, I'll share all that information. It's way more than I can, you know, I could talk for, you know, the next week on all this stuff. I spent a year of my life, you know, researching the crap out of it to learn all this stuff. You talk to 5 different lawyers, you get 5 different opinions. So I then had to figure out from those 5 opinions somewhere in between. So we went through sole proprietorships, we went through the various levels of partnerships. Generals, limiteds, limited liabilities, we went through the different corporations. There's lots of information out there. The C corporation will be the equivalent to our Canadian corporations, our Ontario numbered corp, our Manitoba corp, that sort of thing. The S corp is a flow-through entity. What that means is, say you're a dentist or a doctor and you have your own little dental practice. The money that your dental practice makes doesn't necessarily have to, you know, you don't necessarily want it to pay taxes. You can just have it flow through into your personal taxes as, you know, Keith Gordon, you know, doctor of dentistry. So that entity does not exist in Canada. The one at the bottom there, you'll hear a lot of folks talk LLC just stands for Limited Liability Company. It's a very simple structure. It's like a corporation, but with like a lot fewer rules. It's a lot cheaper to get, it's a lot cheaper to file, a lot less onerous restrictions on the paperwork. The only trouble is, well, it's a flow-through entity as well. And Canada, our CRA, does not recognize flow-through entities. So if you ever hear about double taxation, if you're investing in the US and you're gonna get double taxed, if you put your stuff just in an LLC and have it flow through to your person, your Canadian person, you're gonna pay tax down there to the IRS, and then CRA is gonna still want the full boat on the tax, on the money you made in the US. All of it, just the way it is. So you have to at least do something else to recognize from the accounting standpoint. So the LLC is good to protect you from the legal standpoint, but it's not gonna protect you from the double taxation. And then there's also things that you can get into with trusts if you have children, if you want to do succession planning, if you want kids not to be able to access money, say, until they're 25, or be able to sell off properties. Or you can even, if you really want to be a controlling parent, you can even set up trusts that they can't even sell off the properties. Long after you're gone, your kids will still get a check every month, but they still can't get to the principal. And it's going to be kept at arm's length by you know, your designated lawyer, you know, so you can control your kids beyond the grave. In any case, so Steve Martell does a course, real estate investing in the U.S. for Canadians, and he talked about going to Deloitte & Touche, the big accounting firm, and spending $35,000 to have a structure set up that was relatively complex, and if you signed up for Steve's program with him and spent I think it was $35,000, he would give you this $22,000 structure, you know, as part of your sign-up cost. Well, the structure, and the interesting is I took this course after I had already done all the setting of my own stuff up. I was pretty happy that I came out pretty close to what Steve had come up with. And John and I had spent about $8,500 plus our time, so our time had to be factored in that. But we spent about $8,500 in legal fees to get to what he had said, you know, cost $22,000. So not too bad. Is that the next slide? No, it's not. Okay, there is the brain explode slide coming up here. But yeah, I was already mentioning you have to avoid paying taxes twice from liability. You are going to get sued if you're in the U.S. It's just going to happen. If you're going to buy and hold, it'll happen sooner or later. So we used entity structures. That was number one. The next one was we isolate our assets. So the properties that we have in the U.S., we're going to have a separate LLC once we get to a certain amount of equity. So if we've got a $100,000 house, we'll put that in one LLC. And then if we have, you know, another $100,000 house, we'll put that in a separate one, because that's about as much equity as we want to expose to the world. If we buy 3 condos and each of them is only $35,000, well, maybe we'll leave 3 of them inside one. So it's, you know, but we have our threshold. Our partnership, we decided our threshold's about $100,000. We also have, of course, liability insurance. That's, you know, just pretty much you want to have that, just like fire insurance down there. It's pretty much a given. But the other one is strategic mortgages. I'll show you when I get to the diagram, but I can essentially buy a property down there with 100% cash. Then I'll take one of my own entities and I'll write a mortgage on it. Then that entity will make a mortgage payment back to my own entity. Now, why would you be doing something like that? If you're familiar with the US, there's a lot more public information down there with things regarding, say, who the mortgagee is and how much they owe. Good lawyer, good contingency lawyer, he has one of my tenants slips and falls, one of my tenants wants to sue me. They can go and get a lawyer on contingency to go and look at my property, see how much I owe on it, see what the mortgage is. Now, if that mortgage is there, was filed from my own entity, they're not going to be able to get that much information. They're not going to figure out that my partner John and I own 2 entities up the chain. You know, they're not going to be able to figure out who that mortgagee is. What they're going to see is, oh, this property is worth $100,000, but it's got a $95,000 mortgage on it. Gee, there's only like $5,000 in equity here. the lawyer's gonna go, well, that's not worth my time. Let's go somewhere else. And so that's being strategic with your mortgages. It prevents you from having to employ your liability insurance. It prevents you from having to, rely on these other aspects. So that's just being, smart planning. And then you also have to worry about how to actually move your money north. Now, I haven't got into a lot of this yet because we agreed that we're gonna keep all of our money redeployed. We're rolling everything back into the States for a minimum of the next 5 years. As long as stuff down in the States is cheap, we're gonna keep, we're gonna leave all our money down there. None of us need the money to live on. But we plan on basically growing it as fast as we can so that 10 or 15 years from now, we don't have to do anything else. However, we are set up. We do have our structures. We do have our bank accounts up here so that we can gradually move money up via, like, the dividend method. So, this is what I didn't want to start out with. This is the head explode part. But when I talked about talking to all those lawyers and all those accountants,